Who likes other people's money? Man, what about the rest of you? You like your money, huh? Okay, well, that's fine. All right. So, other people's money, what does that do, right? It gives you leverage. Who thinks leverage is good? Thank you. And who thinks leverage is bad? Okay. So, leverage is neither. Leverage is actually neither good or bad. What leverage does, simply, leverage magnifies your results. So what does that mean? Well, yeah. So if you're making money and you add leverage to that, it's going to increase the amount of money that you're making, right? And I think that's where oftentimes when we hear debt or leverage, that's where we go. Man, I can make more money because I'm going to add debt and leverage to what I'm doing, right? And we get excited about that. And that absolutely is true, and that absolutely can happen, okay? But there's another side of the coin that you always have to keep in mind. Leverage simply magnifies results. So if you're not making money, if you're losing money, and you add leverage to that, you've dug yourself a much deeper hole. Okay, so I share that because it's something that, again, I'm not looking to scare you, but I want you to be mindful of, because leverage is simply a tool, and it's a tool that you have to be responsible with. If you're not responsible using leverage, you can get yourself in a lot of trouble. And when you go out and raise money from people, the other thing is you want more than just their money. Anyone have an idea what I mean by that when I say you want more than just their money? You want their trust? Yes, ma'am? Yeah, I want their trust and interest in a project. Anyone else on this side? Some relationship? Yeah, absolutely. So, yes, you want their money for a deal, but as you go out and raise money, one of the things you want to be asking yourself and looking for from the people that you're raising money from is, what else can they offer you? Can they open the door to new relationships, to other relationships? Perhaps they can open the door to relationships for you to get more money. Perhaps they are, maybe they've been in the real estate business for 20 years and they can add value by consulting or helping you through your real estate projects. Okay, so you want to be thinking more than just money. That's the ideal scenario, right? Because look, at the end of the day, if you've got a scorching deal that you need to get money for and the person can't add any more value other than money, well, you're going to take their money and you're going to do the deal, right? It's not necessarily a reason to say no to someone, but just things that you want to keep in mind as you go out and look to raise money. So when you raise money, basically you got two buckets, right? You've got debt and you've got equity. So debt is pretty straightforward. It's just simply a loan. And on that loan, you get a fixed return on that money. So on the example there, right, if you raise money and it's debt at 100% and you pay them 10% interest, it's straightforward, right? Their return is fixed. It's a fixed return on their investment and that you're offering when you go out and raise debt. Equity, on the other hand, is performance-based. So when you go out and raise equity, you're giving away ownership in, whether it be your company, the deal, whatever the case may be, you're giving away ownership. And how they get paid is based on the performance of that entity, of that deal, okay? And you can split it up a lot of different ways in terms of when you give up equity. Here I said 50% of cash flow and 50% of sale proceeds, right? Like, there's flexibility. You can maybe only give them 20% of cash flow and you give them 40% of the proceeds whenever you sell the property, right? There's a lot of different ways that you can structure it, but when you go out and raise equity, again, it's performance-based. And there's pros and cons to raising both debt and raising equity, and we're going to get into those as well as the different types of debt and equity that you can raise. So the first category of debt that we're going to talk about is private money, right? And some of the ways to raise private money, probably the easiest way, or the place most people start, at least initially if there's money there, is friends and family, right? Anytime you have a warm network, oftentimes that's going to be the easiest place for you to raise money. So you have friends and family, you have IRA money, right, through self-directed IRAs, which I know Rick was talking about this weekend. You can go hard money, right, which is, we have a hard money lending business, and typically hard money lenders are 3 to 5 points up front, and then interest rates of anywhere from 13 to 18%. And when you raise private money this way from any of these sources, typically it's secured by a mortgage and a note is what you're giving. Now, sometimes if you're with friends and family, that may be a little bit different there. And also dealing with friends and family is, I think, a personal choice. As I said, I think friends and family is the easiest money to raise, especially if you're starting out, because you have those warm relationships. But I also know there are some people that say, you know what, I have no interest in involving my friends and family, because they're like, you know what, if a deal goes bad, then, you know, Christmas dinner isn't quite the same anymore, or Thanksgiving isn't quite the same anymore. So I'm not here saying, hey, go raise money from friends and family. I'm telling you, it can be probably a great resource and your easiest resource, but you want to make sure that you know, that's something that you're comfortable doing. For me personally, when I first started out, I did not go to friends and family. I just did not want to do that. I wanted to get the business started. I wanted to have success, and if they came to me, that would be fine, but I didn't want to go out and ask them, and that was just the way I started. So went out and raised money elsewhere, and then as friends and family saw what I was doing, they were like, hey, Doug, what are you doing? Like, you know, can I invest some money? And, you know, I said, sure. So again, it's a personal preference thing, to each their own, so you have to figure out what works and what makes the most sense for you. The other type of debt that you can get is bank financing, right? So we spoke a lot about the underwriting that banks do when you go for financing there. And there's a handful of different loans that you can get from banks. You can get a purchase loan, right? So another purchase loan is simply you're going to acquire a property. A bank's going to give you a loan to purchase that property. You could get a takeout loan. Another word for a takeout loan would be like a refinance, okay? You can get a construction loan, pretty straightforward. You can get a construction perm loan. So a construction perm loan is where a bank gives you money for construction, and then once you're done with construction, that loan converts to a permanent loan ongoingly. Does that make sense? So construction perm loans can be a great tool if you are buying properties that need renovation that you want to hang on to keep as a rental once you're done with the renovation. The other thing is lines of credit are, you know, fantastic. And I have credit cards on there as well, which, again, not recommending necessarily, but how I actually started out, that first property that I said I purchased for $13,000 and put $8,000 into it, how I did that was I got an advance on my credit card at 0% interest for 12 months, and that was how I purchased it, and that was how I renovated it. Now, I'm not saying you should go out and do the same thing, but any idea why I felt comfortable doing that? Well, if you remember, right, yesterday we spoke about generating infinite returns. I only felt comfortable raising that money from the credit card and taking that because I knew on the back end I was going to be able to go to the bank because I had this asset that was worth 40. I was into it for 21. I knew I was going to be able to go to the bank to get a mortgage, and with the mortgage the bank gave me, pay back my credit cards. Right? So you have to have a plan. And even though that was the plan and it worked out well, thank goodness, you know, stuff happens. So again, you got to think through kind of what are some of the best options for you. So we've got a bunch of different types of loans there. Can anyone think of maybe a circumstance where for a single piece of real estate, you might use a combination of these loans? A takeout loan? Okay, yeah, yeah. Yes?
You may use a combination where you start out with one loan and it doesn't have to be, and then you find out that it's not enough money, and you'll have to use another loan.
Yep.
Finish the deal, and you have to do it.
Absolutely. He's saying if you have one loan and then you run out of money and then you need a second loan, that is one way. Hopefully, no one's ever going to be in that scenario, right? But that absolutely is. Another way could be, which I think you were saying with the takeout loan, you may buy a property, renovate it with cash, and then go get a takeout loan to pay back that first loan and recoup your money. right? That could be one way. The flip side of that is you may go buy a property cash, go and get a construction loan, and then when you're done, refinance. There's a lot of different ways, but just trying to, even though we're listing these different types of loans individually, they often can be used in conjunction as you're building a portfolio and as you're working those deals. So when it comes to bank financing, there are typically two types of banks. There are portfolio lenders. The portfolio lenders typically are small local banks as well as savings banks. So what a portfolio lender is, they're a bank, right? They go out, they issue you a loan. They issue you a loan, they issue you a loan, they issue, 10 people a loan, and they actually keep those mortgages and those notes in their portfolios. So as a result, they want to make sure that you're going to be able to have the ability to pay back that loan, because if you don't, that's going to impact their situation because they're holding in their portfolio that mortgage and note that they issued you. Everyone with me? Okay. The other type of lender is called a non-portfolio lender. This is typically larger institutions, although small institutions do this as well. And a non-portfolio lender, they're going to do the same thing. They're going to go out, issue loans to you, loans to you. You get 10 loans together. But a non-portfolio lender is, they're not keeping that in their portfolio. They bundle those loans together and they sell them on the secondary markets to Wall Street. Okay? So, you all remember the 2008 subprime mess? So there's a whole lot that goes into that and what caused that. And there's a great book, actually, the movie just came out, The Big Short, by Michael Lewis. The movie's in theaters now. I'd highly recommend it. The book's fantastic. The book's always better, right? So if you're a reader, read the book. And it goes into all the things that led to that mess that we were in. But this right here, I'll just take a moment, was one of the issues that led to that. Because usually the biggest issues were with the non-portfolio lenders. Because the non-portfolio lenders, they were less incentivized to make sure that you'd be able to pay back your mortgage because they weren't holding it on their books, right? So if you didn't pay back your mortgage, it didn't matter to them. They had already sold your mortgage in the secondary market, right? So it's just interesting sort of kind of how things evolve and how things happen. And, just this is, I guess, a little bit of a tangent here, but these are important things to know because when the subprime market hit, or when the subprime mess hit and all banks stopped lending, we were still able to get financing. A lot of people were still able to get financing. And where we were able to get a lot of our financing was with portfolio lenders. Portfolio lenders that were smart even during the boom with their money because they were still in good financial positions and able to lend out their money. Obviously, the ones that were scrupulous during that time, that were portfolio lenders, well, they did go under, right? But again, as markets change, those are some of the things you've got to adapt. You've got to figure out where you can get your money. Does that make sense? Okay. So with regards to bank financing as well, there's different types of loans and terms, whether you're getting a residential loan or you're getting a commercial loan. So typically, on a residential loan, banks will give you a 30-year amortization. So what that means is the 30-year amortization or an amortization schedule is how they calculate your monthly payment. It's based off of a 30-year amortization so that you're making those monthly payments every month, and at the end of those 30 years, that loan is fully amortized, meaning it's paid off, okay? And they also give you a 30-year term, meaning you don't have to pay them back for 30 years. The amortization is what they use to calculate what your monthly payment's going to be, but the term is when you actually have to pay back the money. And right now, I'd say rates are probably somewhere between 3 to 5%. That's a little bit of a window there. I'm going to talk more about commercial financing in a second, and also, as I said, I always like to speak from experience here. I have very little experience on the residential side, even though I may be doing residential development. The last 8 years or so, I've been using all commercial financing, and I'll explain why in a moment. So Again, these are kind of the terms that you would see from a residential perspective, and then typically somewhere between 70 to 75% loan to value is what a bank would be willing to lend you. On the commercial side, typically the amortization schedule with commercial financing is shorter. It's typically 20 to 25 years. So if your amortization schedule is shorter, does that mean you have a higher mortgage payment or a lower mortgage payment? Exactly. No. You have a higher mortgage payment. The lower the amortization schedule is, the higher your mortgage payment. Because now, instead of them calculating your payment and giving you 30 years to pay it back, they're now calculating your payment based on 20 or 25 years, so you got to pay more each month because you got a shorter time frame to pay it back. Typically on commercial loans, your term is usually 5 years, okay? There is commercial financing you can get where you can get up to 15 years or so, but typically it's a 5-year term. And the interest rate there is 4 to 6%, so it's a little bit more money, and the loan to value is still comparable at 70 to 75% LTV. So if you compare the two, do you get better terms with a commercial loan or a residential financing? What's that? Residential, right? You get better terms, right, on the residential side than you do on the commercial side. Yes, sir.
Okay. With the commercial loan, it says 20 to 25-year amortization, and you have a 5-year term typically.
Yep.
So that means even though it's amortized for 20 to 25 years, I got 5 years to pay it off.
So that's a great point. Did everyone hear what he said? Do you need me to repeat it? Yeah. So even though the payment is based off, let's call it 20 years, that for me to pay it off in 20 years, the term, I've got to pay back the loan in 5 years. So what happens when it comes to year 5?
Refinance it.
Well, right. You can refinance, get a new loan, you can sell it, but yeah, so you've got to figure that out.
You can choose different exit strategies.
Yeah, different exit strategies. Maybe you want to sell it, maybe you want to refinance. As I said, these are, the 5-year term is typical. Oftentimes when we're getting financing, at least for our permanent financing, we try to get at least a 15-year term because in case anyone hasn't noticed, rates are kind of low, right? So we try to lock that in for as long as we possibly can. Question in the back? Great question. So why not amortize it over 5 years instead of 25? Your monthly payment on a 5-year amortization is going to be, that property isn't going to cash flow for you anymore. It's a great question, though. What's that? Oh, okay. Not another. Hold on. Yep. That's a great question. Well, so why would you use a commercial loan instead of a residential loan, especially if you don't have to? Any ideas? Just raise your hand just so I can see you. Yes, sir. What's that? Your payments, well, on the commercial side, your payment's going to be more. Yes, you're absolutely right for residential. So yeah, in terms of terms here, right, what's on the board, your residential financing is going to be cheaper than your commercial financing. So the question that was asked in the back, which is totally appropriate, why would you use commercial financing then, which is what I just said. Yes, sir.
Well, because if you're rehabbing for profit, you're going to make you sign a commercial loan, and a lot of times they're renewable anyhow. If on a 25, you go 5, they're renewable. If you do it for profit on a rehab loan, a commercial note, it's typically 1 year.
So you're saying it can be renewed, the commercial loan you're saying can?
Yeah, you've got to reapply for it. I mean, you don't check the credits and all that, but typically they're renewable.
Correct, that's a good point. So he's saying even if it may be a 5-year term, typically you can renew it with the same bank as long as everything is fine. Yes?
Is it possible that if you select to do a commercial loan, you intend to pay it off sooner than later, and that way you're not having to pay as much interest on it anyway?
So that's a great point. Could be because you intend to pay it off sooner rather than later, and that's why you're looking to do that. That could be, for me personally, that's not why we went that route, but absolutely. So there are a few advantages, and the biggest thing is when you're raising money, there's two, and you should write these down, two things that you want to look at. One, is the cost of capital and the terms, which is what we're talking about here, which is extremely important. Just as important with that is the ease of capital. Dealing with commercial banks and commercial financing is a heck of a lot easier than dealing with residential banks. And let me ask you, are you looking to do one deal or 12 deals a year? 12, right? You're in the real estate business, right? And when you start doing volume, you want to deal with financing sources that are going to be able to keep up and be easier to work with. So commercial banks have been a lot easier to deal with. The other thing with residential loans is that, and again, I'm not speaking from experience here because I don't have this, but my understanding is I think that with Fannie and Freddie, you tap out at like 10 loans or something that you can have in your personal name. So once you hit 10, you can't get more loans than that. Yes?
So I know if you've had any experience with doing commercial loans from REO properties.
So the question was, do I have experience with commercial loans for REO properties? Yes, but what is it? So you just wondering if, yes. Yes, sir.
If you can only do 10 to 12 loans in your name, could you go in and get other loans in the name of an LLC? Would they let you continue, or they just cut everything off at that point?
So I'm not sure, because again, the 10 loans I was talking about is on the residential side. So are there workarounds for that? I don't really know. Again, everything that the last 8 or 9 years has been on the commercial side. So the other thing is, while I do have all this debt, none of it shows up on, I have millions of dollars of debt on the commercial side, but because it's not personally in my name, it doesn't show up on my credit report. Now, I still personally guarantee it, so, if things go belly up, they're still coming after Doug Faith, but it's not on my personal name. Now, so this is another thing with regards to the personal guarantee. Once you get to large enough deals and in certain situations, you actually don't have to personally guarantee certain loans. So this is something I'm kind of just at that point now with some of the new loans that I'm getting, where I won't have to personally guarantee it. But everything that I've done to this date, I've had to personally guarantee. It's actually interesting, and right, just as I said, I'm always learning from others, educating, going to seminars. Some of the things that I've been learning is that when you get to the larger deal sizes, not only do you not have to personally guarantee it, on that commercial loan, the 20 to 25-year amortization, they have a product in the apartment market where they do give you a 30-year amortization, where they even go up to 80% loan to value, and their rate is between like 3 and 4%, which when you think about that, it's ideal, right? You don't have to personally guarantee it. You get better terms across the board. So I'm on my way to that ballpark, but I haven't hit that arena yet. But that's all part of the growth, right? Just as you guys are growing and learning, I too am doing the same.
Well, you also have a 27.5 years depreciation for the residential loan.
So that's a good point. So he spoke about the depreciation and the depreciation schedule. He said on the residential loan, you have a 27.5-year depreciation schedule. The type of loan is not what determines your depreciation schedule. It's the type of asset. So even though I'm getting commercial financing, it's still on residential properties. So it's still a 27.5-year depreciation schedule because there are residential properties. I'm just using commercial financing, right? And again, the commercial financing, instead of being my name personally, Doug Faith, right, it's in a business entity, which again, I'm still on the hook for, I'm still guaranteeing, but we're doing everything through the business entity. And especially as you go out and raise money, I think it becomes a lot more important to run it like a business and to do things in your business through the business, as opposed to your personal name, right? Because there's liabilities and other things that come along with that. And when you start dealing with sophisticated investors, they're not even going to give you money or partner with you if you're doing things in your personal name. It's got to be through the business entity. So let's talk a little bit about, well, just before we go on to equity, any other questions about some of the financing? Okay, I think we got to those. Great. So let's talk about equity. So as we said, equity is where you're giving away ownership. right? They're getting ownership in that property. Typically, I prefer not to give up equity, but it depends on your cash flow situation. It depends on your experience. Why do you think I say typically I prefer not to give up equity?
Because you're giving up part of your company.
Right, I'm giving up part of my company, right? Absolutely. So if I don't raise equity and I get debt and I raise debt, there's also some downsides to debt, right? What's the downside to debt? Well, when I have a loan, typically, I've got to make a payment every single month, right? So if I have a construction project where I have debt, it's a construction project. Do I have any income coming in? No. Do I have to make payments on that? Yep. Whereas if I were to go out and raise all equity, right, you can structure in a way where during that, yes, I'm giving up a percentage ownership, but in terms of my cash flow every month, at least during the construction period, or even once we're stabilized, I don't have to make those guaranteed payments, right? Now, going back to the debt side, there are some ways that you can do that too during a construction period. You can help service your debt. You can ask the bank for what's known as an interest reserve. So they'll give you money to fix up the property. Let's say, in that example, it costs $200,000 to fix up the property. Well, we want $225,000. And that $25,000 is the interest reserve to cover interest payments for that next year while I'm renovating the property. So instead of me having to actually come out of my pocket to service that debt, there's that 25 grand that gets held in escrow, and every month when the payment has to get made, the escrow account gets dinged and covers the payments. Okay? And you can raise money with both debt and equity, right? It doesn't have to be one or the other. It can be a combination of the two. Can anyone think of an example of what would be and when you might use a combination of the two? Well, here's just one example, right? And I guess I showed you this deal yesterday, the warehouse conversion that we're doing. So we went out and raised $300,000 in equity for this deal, and we got a bank loan for $865,000, right? So it was a combination of equity, where we did give up some ownership in the deal for that, and we also raised bank debt to renovate the property. So some of the big things when you do go the equity route, essentially you're forming a partnership, right? Well, it may be an LLC, it may be a different type of entity, but you now have partners when you're giving away that ownership. And the biggest thing is you want to put yourself in a position to underpromise and overdeliver, right? And one of the ways that you do that is you create contingencies. How many people here have done flips or renovation projects before? Okay. Now, I know it's never happened to you, but have you ever heard of going over budget on a renovation or a construction project? Yeah, not you, right? Look, it happens to everyone. If you're in this game and you're doing construction, stuff happens, right? So one of the ways that you can do that is when you have your construction budgets, you put in a line item for contingencies. It's great if you don't have to use it. You got some extra cushion there. You can give that money back to the bank. You can give that money to the investor. But it's important when you're raising money, especially when people are partnering with you, that you put yourself in a position to underpromise and overdeliver. So, and again, this will vary depending on your market and the scope of the project. On my construction budgets, I like to have a 10% contingency in there. Some people like it higher, some people like it lower. But you'll see as you start to put that in there, again, a lot of what I spoke about is like structure and setting yourself up for success. When you add that 10% contingency in there, it obviously changes your numbers, right? So this deal maybe that you thought was such a great deal, it looks a little bit less because now it looks a little bit less of a good deal because you're paying 10% more from a construction standpoint. So there's pros and cons to everything that you're doing. And along those lines, you want to structure it as a win-win, right? I spoke yesterday about the operational contributions versus asset contributions and the mistakes that I made and the lessons that I learned from that. You want to structure it so that it's fair to you. You want to structure it so that it's fair to investors and that they're going to get their money back. And then obviously you have to review the partnership documentation. So let's talk a little bit about marketing yourself and the deal and some of the things that you can do to increase your likelihood of getting money. One, which we already spoke about, owning your financial story, right, in a way that you can inspire others and they're compelled to invest with you. You want to have a proven business model and structure. And that was spoken about this weekend, right? When I was talking about how to generate an infinite return, you've been learning about wholesaling, you've been learning different business models. That's extremely important because what that allows you to do is it allows you to go out and raise money before you even have the deals in your hand, because you know what the end game is, you know the model that you're following. And for me, when I first started, I share with you the model that I used. It was because I had that model, I was able to go out and start looking to raise money before I even had the deals lined up. Because that's a big part of it too, is you want to, if you're raising money, you want to start those conversations before you have a deal. Because once you have a deal under contract, typically, you're like under the gun, right? You have a certain amount of time to close. So to the extent that you can start those conversations for raising money, the easier that it's going to be. And principles and strategies are so important. I actually didn't talk about this yesterday, and I threw in a slide here, which we're going to talk about next. And this ties into having that proven business model and structure. And as I mentioned, they help you line up investors. And when you put this together, the reality of it is most of us have people in our lives that we can help create some win-win situations and have them invest with us. So with regards to principles and strategies, and I just wanted to add this in here, I think it's really important to focus on a single principle and then combine that with working multiple strategies, right? So I'll just share for me personally. Well, first, a principle, the definition of a principle is it's a fundamental law or truth from which others are derived. So for me personally, my investment principle has always been to invest in cash flow, right? So that, and principles don't change, right? So when I started in 2004, that was it, investing in cash flow. We're in 2016, that's still my main principle. Strategies, on the other hand, can change. Strategy is a plan, method, or series of maneuver for obtaining a specific goal, right? So it could be buying and holding, it could be flipping, it could be wholesaling, it could be lending. But you want to get clear on what that principle is, because that drives everything else that you're doing. So even though my principle was investing in cash flow, when I was buying and holding properties, obviously they had to cash flow. Even when I was flipping properties, I had a plan B on my exit where I was flipping properties that if I couldn't sell them, I could still put a tenant in there and rent it out for cash flow. The wholesale deals that I wholesale, they're deals where other investors are going to be able to generate positive cash flow with them. The lending deals that we lend on, right? Those are deals that, again, either are already generating income or once they're renovated, will be able to provide cash flow, right? So the principle stays the same, and then you incorporate multiple strategies as you work that principle. Does that make sense? Okay. So you want to understand and know your investors, and you want to know the investors' needs and concerns of who you're raising money from, right? You want to know their goals and strengths, and you want to know what you're offering them and provide solutions for the things above, right? So I'll just give you an example right now of something that we're doing in our business. So in our lending business, we had a great year last year, and we're actually raising more money now in that business, right? So we're going out talking to investors. And before we go out and talk to investors, we know who that investor is that we want to raise money from. So just to give you an example here, I've got kind of needs and concerns there, right? So we know the investors that invest money with us, they have a large percentage of their wealth in the stock market, right? So some of their biggest concerns are a drop in the stock market because so much of their wealth is tied up in that. So by them investing through us in private lending, we provide a solution by allowing them to take some of their money out of the stock market, right? The other big thing that's really important to them is after-tax returns. And they have a concern about those after-tax returns decreasing. So one of the things we allow our investors to do is they can invest with us through a self-directed retirement account and other vehicles where that money doesn't get taxed. Does that make sense? Right? And most of them are at a point where their monthly expenses, basically, they're not financially free yet. Their passive income doesn't quite exceed their expenses, and that's what they're focused on, is increasing their monthly passive income. So we structure our investments to pay them monthly, right? And that's why it's so important before you go out there. You want to know, I'm giving you an example, real life, what we're doing right now, right? We understand these things so that when we're presenting our investment opportunity, we know we're hitting their needs and their concerns, and we also understand what their goals are and making sure that we're helping them achieve their goals, with one of the big things being for them is, diversifying investments. All right, so I want to talk about advantages of private money, and then we'll have a few questions, and then I think we're going to be ready to wrap up. But as I mentioned, one of the things I love most about private money is it's an opportunity to help investors grow and scale their business. And when you compare private money to dealing with banks, as you've heard me say, I deal both. I work with private money, I work with banks. I don't think one is necessarily better than the other. I think as an investor, you want to develop relationships so that you have access to both bank financing and you have access to private money. So as you see on the screen, some of the advantages of private money is private money in terms of approval times. We give approvals in 1 to 3 days. If you go to a bank, it's going to be at least 2 to 3 weeks before you get an approval, and oftentimes it can take even longer than that from a bank when you go to financing for them. Approval criteria, right? Banks have a very rigid box of which if you don't fall into that box, they're not lending to you, right? Whereas private money lenders like ourselves, we have parameters, but we're flexible, right? I'm an investor and developer myself. We understand with the people that we're lending money to, we understand what it's like. So there's flexibility that we can offer within parameters. Time to fund. When I go to banks for financing, best case scenario is them closing in a month, and that rarely ever happens. More realistically, a bank is going to be 2 to 3 months to get financing from. Whereas we're funding deals in a matter of 2 to 4 weeks. Typically, we can close in 2 weeks. Usually, the issue is more with the borrowers getting all of their paperwork to us. But you're able to close a lot faster. And just the business relationship is different, right? Banks are very bureaucratic and formal. And one of the things I love about the business is it's fun. I enjoy working with other investors because I'm an investor myself as well. We know what that's like. We make it fun. It's very entrepreneurial. And the last thing is the value added, right? You go to a bank, they're going to give you capital, and that's it. Come to us, we're providing capital, but we're also offering consulting and advisory services, right? Because we want to help you grow your business. The more you grow your business, the more deals you're working on, the more money you're going to need to borrow from us. So that means the more money you're going to make, the more money we're going to make, right? So we want to cultivate that and grow that together. Last thing I'll put a slide up here on is this is actually just, we went through a lot of these underwriting criteria, and we're going to go through them now. This is actually our loan package submission checklist, right? So we'll go through it, and you'll see this is similar to the things that the bank asked for, right? You have a loan application. You've got a schedule of real estate owned. We've got basically just an authorization to pull credit, zero tolerance fraud policy, valid photo ID of key principals, business entity information, right? We spoke about setting up a business entity to own your real estate. Oftentimes, a lot of our borrowers have that. We need to get that information. A preliminary title report, making sure that title's good. Proof of collateral for properties. We do require 2 months bank statements. We like to see like 3 months of reserves there to be able to make whatever that monthly payment's going to be. Insurance company info, third-party appraisal, current lease agreements. That was actually one thing I didn't mention. Like when you go to the bank as well and you're sending them your pro forma and all of that, they're also going to want to see the lease agreements to make sure that the numbers that you're putting down on that piece of paper there are aligned with that and match up. And then certainly an agreement of sale if it's a property that they're buying, a payoff letter for the mortgage, and then contractor bids if it's something where they're going to be doing a construction project. So any other questions at all about raising money, whether it be equity, whether it be debt, whether it be private money, whether it be bank financing? Any questions? Oh, we got... Yeah, so this one here? Yep. So while it's up there, I'll just talk through it again, just so you can copy it down. But again, typically, approval time, banks are 2 to 3 weeks. We're 1 to 3 days. Approval criteria for banks are rigid. We're flexible within parameters. Time to fund with a bank is usually 1 to 3 months, more like 2 to 3 months. We're closing in 2 to 4 weeks. The business relationship with a bank is very formal, bureaucratic. We like to make it fun, flexible, entrepreneurial, and the value provided, the bank's giving you capital, we're going to give you capital as well as with some consulting and advisory to help you grow your business. Yes?
What about using funding in your cash value?
So he said, what about using funding with your cash value life insurance? So that's a very advanced strategy, and I mean, you can certainly do that. Yep. Yep. All right, well, if you guys have any further questions or if there's anything else and you want to get in touch with me, that's my website up there. You can go on there, shoot me an email, and thanks so much for having me.